It's been a long season. Hopefully we'll get to start up some live events here pretty soon. Although live, we might not be able to see you because of the mask, but we can always pretend. All right, so I'm going to go ahead and get started. I believe you guys can see my screen. Welcome to SJREI April. So SJREI is where the deals happen. And feel free to ask me anything real estate. You know, I truly live real estate. So just the disclaimer here, basically it says that we don't endorse anything. We are providing education and a networking opportunity. If you take the information from tonight and you go and do an investment and it works out for you, yay, I'll let you keep your profit. If you take your money and you invest it and you lose money, yay, I'll let you keep your loss too.
There you go.
So, yes, our mission is to provide education, networking, and inspiration so that you can make wise and profitable investments. The point is that you will take action. We don't want you to just be here for the edutainment portion of it. We want you to impact your life and see the ripple effect go down to your family, your friends, and everybody included. So we are where the deals happen. If you have been to any of our live meetings, you know that they're engaging and that people are doing deals together. This audience that we have has many people doing deals. And so if you want to get into a deal and you don't know where to start, make sure you're reaching out to us so that we can connect you with the right people. Hey, did you guys know that prices are going up? Surprise! Okay, well, they went up everywhere except San Francisco. Imagine. So let's think about this for a minute. If we're seeing prices rise as much as 16% year over year, everywhere except San Francisco, why do you think that is? It's mostly because people can work remotely. So they're moving outside of the city, they're moving into more suburban, more nature type areas. And so another area that saw almost a 20% increase was a suburban part of Napa. I think that's very interesting. And there's more information. I'm sorry, let me go back to that. There's more information. This whole article, if you haven't seen it, is out on Facebook under SJREI. So you can check that out there. So it kind of got me thinking, all right, what quadrant of the cycle are we in? Because in 2019, in the San Jose, San Jose Mid-Peninsula market, we kind of were going up and then we took a little bit of a sideways and things kind of cooled down a little bit. But now we are clearly in a trajectory going up. So if you had to guess, go ahead and put in the chat box there. If you had to guess, which phase or quadrant do you think we're in? One, are we in recovery, where there's very little new construction? Are we in quadrant 2, which is expansion? Are we in 3, which is hyper supply? Or are we in 4, which is recession? So go ahead and just put in the chat box what you think, which quadrant we're in. I see a 2, another 2, one. Anybody else? One, going 1, 1, 2, 2, 2. Let's start an auction. You know, I believe that we are in phase 2, but I think instead of being up towards the top where demand equals supply as an equilibrium, we have moved back to the declining vacancies, and we're kind of teetering between a phase 1 and phase 2 in the Bay Area. And part of that is that we don't have any new construction. It's very difficult for developers to create new construction with all the rules and regulations. And so we're kind of hovering around that. And the value of knowing that says that we are probably about 2 years out from any fall in our pricing. So if people are like, oh, it's a bubble, it's going to pop, it's going to pop. Most likely it's not going to pop. It may slow down, but pop usually means it reverts back the other way. And I don't see that happening anytime soon in the next year or two. Now, if we look at the national statistics, and this is like looking globally on the national statistics, right now, existing home sales are up 9%. Newly built home sales are up 21%. Nationwide home sales are up 8%. The Bay Area is usually 2 to 4% more than the nation. Okay, and we just saw the Bay Area this year over last year is up 16%. So there's a pretty big jump out there, people. And a lot of that jump is coming from the low mortgage rates. Who remembers the last time they were at 3%? What? Nobody? Okay, me neither. I mean, when I got my first mortgage, it was like 21%. And I was so happy to actually get a house. $500 down. Woohoo, a HUD home. 3% doesn't even account for inflation. So if you haven't bought a property this year, please put it on your goal to buy 1 or 2 at this interest rate, because you are getting free money. Your money is coming to you at a rate cheaper than inflation. That means inflation will help you pay your mortgage off. I hope you guys are listening. All right, if we look at what's happening around the nation, you can see which markets are stable as far as buyers traffic, which one have a lot of buyers, and which ones are super hot. So we in California are in a high buyers market. There's a lot of buyers looking. The problem is there are not a lot of sellers selling. And that is what's pushing our prices up. This is not an artificial bubble. This is based on demand. Demand being created by low interest rates. And if we look at this article, I actually found it on Dave Ramsey's website, which he's pretty conservative. He projects that home prices in 2021 will increase nationwide by 8%. And then he anticipates in 2022 nationwide, they will increase still, but at a slower rate of 5.5. So even if in California, we only went up 5%, 5% on a million, it's still pretty good. It's still pretty good. So my point is, don't be afraid of the market, just be wise in the market. Okay? There are certain strategies that you use when the market is runaway like it is right now. Some of those strategies would be, make sure you're buying rentals. Again, with interest rates as low as they are, this is the best retirement plan you can have. You know that thing called Social Security? How about personal security? It's right here. If you're looking at doing some active type investing, you can go out and buy some of these vacant commercial properties that have quick service opportunities. Like if you see a restaurant, drive-through, quick service that's vacant, put a tenant in there, now you've added value. Always fixers. People have to move for some reason or another. The property is dilapidated. You go in and add value as a fixer, and voila, you make some really good money in this marketplace. Anything that you buy and add up to 499 square feet, you are going to see a good return. Now, why do I choose the 499? And I'm talking specifically for the Bay Area. The main reason I suggest anything up to 499 is that most of the municipalities here have a addition, like you can make an addition under 500 square feet without going through a full planning review. What that means is that you can get your permits and your plans reviewed usually in 3 months or less if it's under 499 or if it's under 500 square feet. If you're over 500 square feet, that could be 6 to 9 months before your plans are approved. So if you can add that 499, your cost to build out here, if you're good, is going to be $200 a square foot. If you make some mistakes, it's probably going to be about $350 a square foot. And what are we selling for? 600, 700, 800, 1,000. So you can add significant value with very little risk if you know how to manage rehabs. And if you don't, please talk to me because this is my life. I live this. That's what you want to be doing. Another strategy is if you have properties right now and you're thinking, I just really want to increase my rents, you can add your ADUs. You can get 2 more properties, basically rentals, on your current property. You can get a junior ADU and a detached ADU if your lot will support it. Other ways that you can make money in this marketplace is value add opportunities like lot splits, redevelopment, and infill. So these are some ways that you can get involved in this market and capitalize. So before we go to the speaker, I'd like to go ahead and open it. If you have any questions, go ahead and raise your hand. Hopefully Jeff will be able to unmute you. Any questions? Okay, it looks like
yes.
Yep.
Yes.
Yes.
Jane.
Hold on, Jane. Jane, hold on. I've got Gita first, and then I'll come to you, Jane. Hold on. All right, Gita.
Hi, Lori.
Hi.
I was just wondering, how is the rental market doing right now? I'm hearing it's, in Bay Area, I'm talking specifically. I heard it's gone down a little bit. I know San Francisco for sure has gone down. I'm not 100% sure how is the rest of the Bay Area doing.
So it depends on the area specific on which ones. Thank you for the question. The question is, how is the rental market in the Bay Area doing? And again, it's hard to speak globally because we know San Francisco is having a hard time with rents. Surprisingly, the Mid-Peninsula and San Jose is still very strong for rents. They are not having to offer much for concessions. So it's still very strong. All right, so now we'll go to you, Jane. Go ahead and unmute yourself, Jane. Are you there, Jane? All right, any other questions while we wait for her to see if she comes back to us?
Okay, now can you hear me?
Yes, we can hear you.
Okay, I've been staying in Santa Cruz for the past 2 weeks, and I read in the local newspaper there that house prices year over year in Santa Cruz have gone up 31%.
True. All the people from San Francisco went there.
And yes. San Jose?
Yeah, I mean, seriously, let's think about if you are now being told by your employer, which many of the employers are offering the option for people to now work from home. Are you going to want to work in a neighborhood where you're cramped in, or do you want to go to somewhere where you can be to the ocean in a couple minutes? Of course. Yeah. Yes, that is true. That is 100% true. And it's always important to watch these migration patterns, you know, think about Lake Tahoe and Reno, and, you know, a lot of people are moving up to Idaho and working for, you know, still working here. So I don't know about Idaho, that's a little cold for me, but you know, there's a lot of places to move out of the Bay Area. Now, does that concern us as far as our housing prices? I don't think in the short term it does, because how many people are moving in versus how many people are moving out? We don't see a net migration where we are all of a sudden having all these vacant houses. Could we? 100%. So those are things that you have to watch. You do have to pay attention to those. Awesome. Okay, and our upcoming events next month, we have our deal architect, Brian from Note School. He's going to come in and he's going to share information on how to structure deals. And I want you guys to think about this. Here we are in one of the hottest markets that we've seen in a long time. And sellers are still offering to seller carry. In 2020, 4 of my deals that I did were seller financed in places like Cupertino. And everybody tells me, I can't do that in the Bay Area. Not only did I do it in the Bay Area, I did it in Cupertino. I did it in Santa Cruz. I did it in San Jose. So he's going to come in with ideas that are going to blow your mind up, with great ways to structure deals to reduce your risk and increase the amount that sellers will get. And it's a win-win. If you can go in with a higher price for the seller when you're trying to buy, they're more likely going to sell to you. And it still is a good deal for you. So check us out next month. And without any further ado, we have Ed here. Let's give him a big round of applause. Ed, thank you. So Ed comes to us with over 15 years of experience. And he's going to talk to you about BRRRR. He added an R on there. And you're gonna learn something that you will want to put into play this year. Because I'm telling you again, these interest rates, if we ever get back up to 21% or even 20%, you're going to be going, I wish I would have, woulda, coulda. And you have the opportunity now. So Ed comes to us with experience buying, he's manages property, and he coaches and teaches. And so we have the honor to learn from somebody who's in the game right now. And he's going to teach us how to do it. So Ed, welcome.
Thanks, Lori. I appreciate it. Hey, everybody. Thanks so much for having me here. Forgive me if you guys, I see a lot of you guys seated. I like to do standing presentations. I really love being in front of people. So even when I'm virtually, I still stand because I like to move. You know, I like to kind of get up and kind of get in it, like if I was right in front of a group of people. So I'm sorry I can't be there. But let me go ahead and get my screen shared here.
Here we go.
And try to get everything all squared away here. Get everything all configured. Give me just a minute, everyone.
Mm-hmm.
It's nice to see everybody's face. You guys look so excited back there as you're listening to the presentation. But hey, right now, one of the presentations I love giving is just helping people understand about why invest in rental properties. A lot of groups find wholesaling and rehabbing sexy. I do too. But the thing about wholesaling and rehabbing is once that deal is done, you have to go out and do it again. And I know there's businesses set around it, but a lot of people don't even give second thoughts to rental properties. Almost like, sure, I'll get to that eventually. I'll do that whenever I have enough money in the bank and so forth. But when is that ever going to be enough? So I kind of just like to help people understand why invest in rental property besides just the reoccurring monthly revenue that we're going to talk about. What are some of the other benefits? What do you get as a result of this? And I think Lori already jumped into a big portion of it, is the interest rates. So, I mean, the interest rates right now are so crazy low that literally you're going to be shooting yourself if you don't sit back and get some of these properties at these low interest rates and lock them in for 30 years. And now you've got a solid investment portfolio that's going to continue to perform even if inflation and the interest rate goes up. So that's going to be pretty powerful. Let's get started here. I'm not going to go over all this. Lori went over several of it. I'm an Army veteran, as you can see, but out of all the stuff on this slide, I just want you to think of the last bullet point that I am an all-around great guy. That's what everybody tells me, so I'm taking everybody's word for it. So let's kind of get going. Agenda. I'm going to go over, and some of this stuff, please forgive me, guys, if this is some stuff that you already knew or you knew some of this stuff. I'm trying to just catch everybody up on the same page so that I can get everybody who may know a little bit about rentals, none about rentals, and maybe some of you that know a lot about rentals, that you already own them. Some of it may be already information you know. So forgive me about that. The presentation will speed up, but I'm trying to get everybody up to speed as we move forward here. So we're going to be covering just some of the 4 main benefits that you get from rental properties, why I think rental properties are better investments than others, what does ROI mean, what is an infinite return, and my special topic, which Lori already kind of gave away. Thanks, Lori. I appreciate that. Stole my thunder. No, is we're going to be talking about the BRRRR method a little bit later on. So right now, again, a beginning note, this presentation is going to be filled with information, acronyms, math, formulas. I don't want anybody to get freaked out. I will do all the math for you and we will walk through it. It's very simple, easy math for people. So don't get freaked out about it. And I'm a very extroverted person. I love interactions. I love just talking with people. So please, by all means, if you can, hop on and, if you have a question, be happy to answer them. And we will have a good amount of time at the end of the presentation for Q&A as well. So let's kind of get started. Alrighty, here are the 4 main benefits that we're going to be able to get from rental properties. Cash flow, pretty much people know, right? You have a property, they call it mailbox money, something like that. You just get money every month from your tenants. And of course, the money that you get is going to be, that you charge for rent, hopefully, is more than what your expenses cost. And that's going to present a cash flow for you. Now, here's one of the things that I'm going to explain a little bit later on in the presentation. I'm going to actually explain to you why it makes sense in certain situations to actually accept a negative cash flow. Why would you pay money to have a rental property? We'll talk about that in a little bit. But cash flow is one. Depreciation, that's another one, that nice tax benefit that people get. Mortgage pay down, and then of course appreciation. I don't have to tell you guys in your market about appreciation. Lori was already going over and over about a lot of, and I'm sorry I didn't catch the lady's name, about Santa Cruz going up 31% appreciation per year. That's crazy. And we're going to talk about that too, how appreciation can be your friend. So cash flow. Cash flow basically is just the amount that you have left over after you collect the rent and you pay your expenses. How much is that going to be? So I'd like to introduce at this point just something I call the 1% rule. So typically across the US, as a 1% rule means the property should rent for at least 1% of the purchase price. Now, I know that can go up and down in certain markets. I may not work in your particular market, but you get other benefits besides cash flow. But I wanted to introduce this because a lot of people don't know how to even begin evaluating rental properties. So not that the 1% rule is an end all be all, like that's the best thing to do, but it's just a general guideline. So what we're going to find out, again, if a house costs, in this example, $100,000, it should rent for at least $1,000 or plus a month. If it's at least that, then it's worth looking into. If you have to pay $100,000 for a property and it only rents for $500 a month, well, that may not be very beneficial. You might not cash flow from there, but it still may be worth buying. And again, I'll talk about this later. It still may be worth buying because of some of the other benefits you get from real estate. So, and again, I just like to introduce that particular rule of thumb to people. So again, cash flow. So if we have $1,000 a month, we have a $700 a month payment. Our cash flow is the difference, which is just $300 a month. Very basic, very simple math. And again, I'm trying not to be very technical with this. In some of this presentation, we could dive into more detail. I'm just trying not to, because I'm just trying to help everybody understand some of the general fundamentals. So depreciation. Depreciation is actually just a federal tax benefit that you get from owning rental property. I put the technical definition there if you want to read it, but technically if you're buying residential property, you can depreciate your property over 27.5 years. Now, the one thing I do want to make sure that you understand is that property is broken up into 2 components, the building and the land. The land itself cannot be depreciated. The building itself is the thing that actually gets depreciated. That's the thing that can go down in value. So if you ever notice, if you own rental property or you own your own home, how on your tax assessment, you always have a land value and you have a building value broken up. That's kind of how they charge you property taxes for that. So just want to kind of sit back and explain it, add a little bit more information to you guys. So one of the benefits, again, of this is that only rental properties can get this. You don't get this benefit of depreciation on your primary residence. So again, that's a benefit of real estate. Now that's a benefit you could take or not take. Now, typically in a room this size, I get a bunch of different people that already have experience, maybe some accountants, some tax people. I am not trying to put my foot in my mouth or step into a bear trap on this one here. I do understand that, you know, if you do depreciate property and you end up selling it, there is something called recapture that you have to do and pay some of that money back if you do take depreciation, unless you roll it over into another property. But again, just want to sit back and give you guys some basic information about this. Next one is going to be simply mortgage pay down. Typically, one of the things that we're going to talk about a little bit later on is about mortgages. But if you're going to get a loan on a particular property, this particular property, you're going to have a principal and an interest portion of that payment. The principal portion actually pays down the actual amount of money that you borrowed initially against the property. So, and you're not paying it down, your tenant is paying it down. So as they're paying you rent every month, you in turn get to pay the mortgage, which in turn pays down a principal part of the depreciation. So one of the things I wanted to show you is just a simple little chart here. I kind of just used a very simple internet-based calculator to kind of give you this, this sort of visual graphic. This is an example of a $100,000 loan, 30-year amortization, and I actually put 5.25% interest on this one. Typically, that would be pretty reasonable for a rental property that you can get even in today's market. So as you see, this is from January to December of this year. If you are making a payment, you're going to have in January $438 in interest and $115 in principal. And you see that principal is going to continue to go up and up and up as your loan gets further and further into the amortization. But what I want to pay attention to is a number here at the bottom. This number in the blue under principal, $1,420. So in this example, over the course of 1 year, if you keep a tenant in there for just 1 year, in this example, you will not only get the cash flow, you will not only get the depreciation we talked about, but you will also get an additional $1,410 behind the scenes of mortgage pay down. That's money that you get from paying down a particular loan from the tenant. And that's, again, these are all benefits of owning a rental property. So again, this is the third benefit. The last one is one that I'm sure your market is very readily available of, appreciation. It's just the increase of real estate value over time. Lori and I were talking a little bit before it took place, how, you know, she remembers your market back when it was $300 and $350 a square foot being sold. And that's when people bought, you know, years and years ago. And now the per square foot cost of a property is pretty much doubled. So that pretty much means the property price has doubled for that matter. So appreciation is a great value if you can get it. Now, me personally, I am in the St. Louis, Missouri market. Our appreciation, you know, not necessarily appreciate the way you guys do in California. Again, we don't kind of move and groove like the coast do here in the Midwest. But one of the things I want to make sure that you understand is that if you're in California, and even I mentioned Las Vegas markets, these things are crazy. I mean, you're getting $100,000 or even $150,000, $200,000 appreciation on $1 million properties per year. That's crazy appreciation for that. I mean, that right there may be worth, well, I'm kind of jumping the gun. I almost gave it away here. I'm going to kind of pause on that until I get a little bit later on in the presentation. So appreciation, again, is the fourth value of owning a rental property. So you just own it over time. Even when I say over time, it doesn't even mean a long time. You buy a property, just imagine this, you buy a property, you have one tenant in there for 12 months, and then you turn around and sell it for $100,000 more than what you bought it for. Sounds pretty good, doesn't it? And you're getting cash flow, you're getting depreciation, you're getting mortgage pay down, you're getting all that stuff I already told you about, and you're going to get $100,000 on top of that, like a big old cherry right on top of your sundae. That's awesome. So one of the things I want to sit back and explain at this particular point is the priority of how people typically look at these four things. So a typical cash flow investor, as you see here, might, out of those four values, he might value cash flow first, then mortgage pay down, then depreciation, then appreciation. And that you can arrange these in any order that you want, but some investors take these in different priorities, meaning depreciation. Some people may not want to take a tax advantage. So that may be the lowest priority of all four for them. That may be the last one. So cash flow may be the biggest. In our area, in the Midwest, I know cash flow is what we're looking for. Okay, but because we don't have those swings of appreciation like you guys do on the coast. But I'm a high net worth investor. You know, if you make a lot of money, doctors, lawyers, these people make a lot of money and they need write-offs. They need ways of reducing the amount of taxable income they get every month. So depreciation could be a lot higher on buying real estate than the actual cash flow because they already have cash. They just want the write-offs, but they also can get mortgage pay down and appreciation and so forth. Now, in your guys' area, I would say that appreciation might even be the #1 value in your area because appreciation is so high. Follow me on this example here. This isn't a part of the presentation, but I try to customize it based upon what I'm hearing. And I'm just taking an example here. I'm looking at some of my notes. Santa Cruz, lady said, went up 31% per year. So 31%, you have $1 million property, goes up 31%, it goes up $310,000. So now after 1 year, your $1 million property is now worth $1,310,000. I'm just trying to use a basic example for this. Now, let's also assume that you have a property that you bought and you're renting it, but you're losing, let's just say you're losing $3,000 a month in rent. So not only is this payment so high, you can't even rent this property for what you have to pay in your mortgage. So let's just say, and I'm just throwing out numbers. Again, this is completely on the fly. You might be paying $6,000 a month for your mortgage, but you may only be renting it for $3,000. So that means a $3,000 gap at the end of every month that you as the investor have to pay on that particular property just to even own it. Doesn't sound very attractive, does it? I mean, I'm paying out $3,000 and it's kind of like mind-boggling. However, if you do the math, you have $3,000 going out over 12 months. That's only $36,000. And I say only, I don't mean to make it sound that way, but you're paying out $36,000 in negative cash flow, but you just went up 31%. So the property now is worth $310,000 and you had to pay $36,000 to keep it for that year. So what did you actually net? If you sold that property and you had to pay $3,000 a year, what did you actually make on that property? If you were to sell it 1 year later, like I said in the example, take a property, hold it for 12 months, have it appreciate at 31%, and then sell it the next year. You would make an example, something like $270,000, $280,000, something like, I would say $270,000. Is that worth being negative $3,000 a month for a year? Maybe, but a lot of people played that game, the appreciation game, and they lost back when the market went the other direction. Excuse me, Lori had that chart up about what growth phase we're in. So the thing you don't want to do is, if you're going up, that's great. That's a good phase to be in because appreciation is going up and house values and so forth. But what you don't want to be is on the downward, trying to make it, I don't know the right angle for this, but you don't want to be on the downward portion of that because you don't want to be on the point where you're negative and then the property doesn't appreciate because now you've actually lost money. So it is a game on that one. So you do have to kind of play the market, know what phase of the market is in. So it is a risk, but is the reward worth it? So just trying to give you guys an example of how these benefits can work differently. And you might use them differently depending upon where you are. So moving on, I'm just I'm not checking the chat here. So I'm sorry. On that one, Jim, I don't know if you want to hop in but I'm just trying to look and make sure that I'm looking at some of the notes. Sorry,
I'll check for questions, Ed.
Okay, awesome. All right, well then I will pay attention to everyone else in the presentation. Awesome. So thank you so much on that. So why rentals are better than other investments? First of all, we've already talked about 4 pretty good damn reasons. Cash flow, mortgage pay down, depreciation, and appreciation. So first of all, those are all 4 great things. So now we're going to add the 5th one on top of it, which is bam, leverage. Leverage is the one biggest thing that I think helps real estate over any other investment. Now, what do I mean by leverage? Leverage is the ability for you to borrow more money on a property than you actually have to pay for it. I'm sorry, that didn't come out right. you actually get to borrow more money against a property with a lower down payment, a lower amount of money. So in this example here, what I'm going to do is talk about how real estate versus stocks. So in a stock, you can't borrow any money. If you're buying $20,000 worth of stock, you're going to have to pay $20,000 for it. And it may go up, it may go down, but there is no leverage. There's no bank that I know about, no stock fund that's going to sit back and loan you money to buy more stock and then give you an interest rate, and hopefully it does well. However, with real estate, if you want to purchase a $100,000 property, you could use that same $20,000 as a down payment to buy 5 times worth that value in real estate. That is leverage. And banks do it all day long. I mean, I don't know about you guys, but I get stuff daily. Hey, you know, I've got funding for rental properties, funding for this, you know, we do 30-year funding. I mean, all these funds that are coming out that have just tons of money that they're loaning out for 30 years at low interest rates. So it's not just banks. There's lots of other funds out there that they're pulling money and doing this. So again, the benefit of leverage is being able to use 5 times what you currently have to actually buy real estate. That's awesome. So $10,000, just imagine, and then go back and say it's 200,000. Well, 200,000 will buy you $1 million in this case. So again, your leverage allows you to buy more, which is awesome. No other investment can do that. So now that we kind of are talking about investments and we're talking about rental properties and leverage, I want to kind of hop into what is a return on investment. So if you're an investor and you've got money and you want to put money in, how do you know how well it's doing? How do you know what you're getting back on this? And I'll just cover this very briefly here. Return on investment formula. And again, I'm trying to keep it basic here. There's more advanced formulas out there to do exact calculations, but you just take your total income minus your total expenses divided by the investment that you have on the deal. That's it, how much money you have in on the deal. So let's take a look at the example that we talked about earlier. So we have stocks. We have $20,000 to invest. We purchased $20,000. Now, typically stocks may go 5 to 10% on average, and some people may do better, but I'm just trying to use a basic average. So this is the return that they make. They can lose value. Okay, that's one thing that they can do. And other than just an annual or monthly or annual returns that you might get, depending on the type of stock you buy, that's about it. That's what you get out of it. There's no depreciation. You get no tax incentives. There's nothing like that. Real estate, of course, is different. Purchase price on this one, let's just say we're dealing with $100,000 to keep numbers nice and easy. We're investing $20,000 because a bank is going to loan us 5 times more than what we have against a property, as long as, of course, we have credit and qualify. Following the 1% rule, let's just say it rents for $1,000. So a yearly income is going to be $12,000. Our total expenses that we looked at earlier, we just kind of threw out $700 as a principal, interest, taxes, and insurance type on this particular property. So that's our total payment over 12 months. That's $8,400. So we take our total income minus our total expenses divided by the money that we have in on the deal. So if you take a look at, we've got $3,600, which is the difference of how much we made over our expenses divided by the $20,000 that we have in on the deal. That's our money that we put in. So we have an 18% return on investment for this particular property. Now, this is 18% just in cash. Okay, please keep this in mind. This is just the cash portion of this. We haven't included some of the other benefits. So cash flow, we already just talked about, is 18%. Let's just say we're appreciating very moderately, 2% increase per year. So that's an additional $2,000 per year that you make in appreciation. Mortgage pay down from the slide that we just talked about, that's $1,410 that we talked about that we get from mortgage pay down. Again, another benefit. Depreciation, this is a little bit more advanced calculation, but how about this? How about you just take my word for it and you take a property that you've invested over 27 and a half years, roughly you get about $636.25 in depreciation on that per year. So all of these things can be done using different calculators. I just recommend calculator.net. It's a free one, it has lots of different calculators if you want to go do this type of stuff, but this right here is all the benefits that you get from your return on investment. Now, the calculator is going to help you calculate total return on investment. And, you know, I'm not going to get into all the like internal rates of return and all these other type of things. I'm just trying to show you basics. These are all the different things that you get. It's not just the cash flow. Cash flow is 18%. You get another 2, another 1410, another 600. All of it adds up. And that's per property. So think about magnifying this by one property, 5, 10, 50, 100. You kind of get the point here. So now that we kind of went over just basic points of return investment, I'd like to introduce a concept called an infinite return. So now I want to sit back and ask everybody, please, who in the audience has heard of an infinite return? Who's heard about it? Who knows about it? More than that, who's excited about it? Because I am. How many people? Anybody? Can I get a hand? Can I get something? No? Yes? Yes? No? Me? Awesome. Thank you. So, infinite returns. Let's talk about that. This is guys, once you start understanding about infinite returns and the stuff I'm talking about here, it's going to blow your mind. Nothing else is going to do it. Nothing else is going to, you're not going to settle for anything else because this is the way that it has to be. So infinite return is, again, think about it this way, your ability to make money with rental property without having any money of your own in on the deal. Zero. Now, I'm not talking about no money down, buy with zero, seller finance. I'm not talking about that. Okay. I'm simply talking about how to buy a rental property the correct way, rehab it, renovate it, put it back as a rental, start making money and get all of your money back out. That's pretty awesome. Okay. All the other stuff, I'm not downing zero down investments or seller finance. Beautiful. If you can get that, but I'm talking about something completely independent that anybody can set out and do that. As long as you find a property that meets the right criteria, this will work for you. So let's talk about it. So why do you call it an infinite return? Kind of goes back to a mathematical perspective. If you look at mathematics, and I'm not trying to blow your mind, but let's look at the example I gave you earlier about $12,000 in rental income minus $8,400 in your payment and your investments of your payments, then divided by $20,000 that you have in on the deal. Now, imagine, look at those numbers I have bolded. At the very top, that's the calculation that we just did. Now, imagine the same deal, but now you only have $10,000 of your money in on the deal. Exact same scenario, and you just keep reducing it. Imagine if you only had 5,000. Now your rate of return is going up to 72% return on investment, just by having less money of yours in on the deal. Keep dropping it by half. Go all the way down to $625. And I did that because I'm just basically taking half of it. I didn't get crazy and keep adding more, but at $625 and on a $100,000 property. Come on out. Isn't that almost free? But at this point, you're making a 576% return. So as you look at it, that arrow just means as you keep going down and lowering the amount of money that you have in on the deal to zero, basically this percentage goes to infinity. It goes infinite. So that's kind of what they come about an infinite return. Has anybody ever tried to divide a number by zero on your calculator? And if you ever did, what do you get? What do you get if you ever divide something by zero? Meaning zero in this equation is how much money you have in the deal. So if you ever try to divide something by zero on your calculator, sorry, looking at some of the comments. Yeah, if you ever try to divide something by zero, it just says error, undefined. It doesn't get it. You cannot divide something by zero, but that in a sense is what an infinite return is in that formula. If you kind of look back at this right here, well, I'm not going to go all the way back, but if you look back at that $20,000 in that formula, if you make that zero, have zero money in the deal, then you have an infinite return. So let's talk about how you do that. Now, I do have a question for you. So imagine if you're purchasing rental properties where you're able to, again, have little to no money invested, you had positive cash flow every month, and you had at least 20% equity in the property when you were done. How many rental properties would you buy? Anyone? Bueller? Anybody? How many rental properties would you buy if that would be the case? Ooh, that was some good words. Infinite, unlimited. You're right. Basically, as many as you can get your hands on. That's exactly what you're looking to do. So that's awesome. Now, this is all great, right? This is all great. Let's talk about an infinite return deal. Let's talk about this before we kind of get a little bit more crazy in the presentation. So this deal example is we're buying a 3-bedroom, 2-bath, and this is not in California, guys, okay? This is Midwest prices. Please indulge me on this. 3-bedroom, 2-bath, and it needs work, okay? The ARV on this property is $100,000, and you're purchasing it for $60,000. Now, that's not crazy. You know, you're getting 60 cents on the dollar. That's very doable for a 3-2. finding a good deal. Do those deals happen every day? Maybe not. It might happen once a month or once every quarter, but the deals are out there. So these are the deals that you have to look for. So purchase price on this one is 60. Let's just say you have 15K in repairs. Good enough for maybe a new kitchen, some flooring, paint, stuff like that to get it up and get it renovated. So you have a total of $75,000 invested in this property, which means that your refinance at 75% loan to value, which again is less than 80. Remember, you get the bank will loan you up to 5 times your value. So $20,000, you can buy 100, and you're not even at the full 80,000 yet. So you're actually cheaper than what you need to be on this one. But I don't know why I have a new loan of $70,000 on this presentation. That's kind of crazy. So sorry about that. But I think I did the loan calculation based upon 75. And here's just some of the numbers. Payment, principal and interest at 414, 200 for taxes and insurance, $1,000 for rent amount. Your money invested, 0, because you get all of it back. There's your investment. Your return is going to be infinite. You're dividing by 0 at that particular point. Your rent minus that, you're making money, and you've got no money in on the deal. So I know what everybody's thinking. This is exactly what everybody's thinking. I know it. I can read your mind. Edward, I'm pumped. Man, nobody ever told me about this. How do I do this? How do I get this stuff done? All right, well, cool. Let's talk about it. This is my surprise topic, which isn't a surprise anymore. Thank you, Lori. I'm kidding. I'm giving you trouble, Lori. So using the BRRRR method. Let's talk about this. So we're talking about the BRRRR method. BRRRR actually is an acronym. It has meaning, and we'll go over all of them, but the B stands for buy. You're going to buy a piece of real estate, and you're going to be either using cash, private lender, LOC is for line of credit, a line of credit, or even a hard money lender. In this particular example, if you do the right calculation, it doesn't really matter which one you use. Once you buy it, you're going to renovate it, do the renovations, make it rent ready, then you're going to rent it. That's the second R. Rent it, find a qualified renter, fill out a lease, and get it occupied. Now, from this particular perspective, a bank, credit union, or other financial institution will see your property as a cash flowing asset. You can now utilize the money that comes from that rental property as income to help pay back the loan. So now at this point, you refinance. So at this point, if you do all your numbers right, and we will talk about numbers here by the end of the presentation, if you do all your numbers right, you can refinance and get all of your money back out of this transaction. But you do have, well, I'm kind of jumping the gun. You do have to find a refinance partner, somebody that's willing to do this with you. And we'll kind of talk about that a little bit later on. Now, the last R is finally for repeat. Again, when I asked you how many properties you want to buy, people said unlimited, infinite. So in order to do infinite, you have to do it again and again and again and again. You get the point. So this is BRRRR, buy, rehab, rent, refinance, and repeat. Now, the biggest thing about this is how quickly can you get this done? How quickly can you go from buying it to renovating it to renting it to getting it refinanced and so forth? I would say, depending on your environment and how quickly the rental market is, you could probably do one of these per quarter. If you want to do it every 3 months, you can buy it, a couple weeks, maybe 3 weeks at most in renovation, get it up on the market, rent it, move a renter in, and then have another, give it 3 or 4 weeks of closing on the back end on a refinance. Again, if they're slow. If they're faster, they could probably do it in a couple weeks. So I think once a quarter would be right. So we got a lot of people throwing out some great information over here. Unfortunately, we'll talk about we got a lot of great ideas on the chat, but got to continue with this so we can get through it. We can talk about all this great stuff at the end here. So moving on, how do you buy a BRRRR method? How do you buy property? Before we can do that, we have to talk about some basics. What is the Mayo formula? MAO. How many people have heard of the Mayo formula before tonight? Anybody? I mean, just looking at some of the feedback on the chat. Heard people? I mean, if hopefully if you've ever done wholesaling, rehabbing, this Mayo formula should be a pretty standard formula that you use. Mayo basically stands for maximum allowable offer. So this is the most you can pay if you ever want to go to a property, the most you're willing to pay for a particular property. So let's look what that means here. So Mayo, we're going to be taking the ARV of the property, what it's going to be worth when it's fixed up, the after repair value, multiply it by 0.7 or 70%. Now that's to give you 30% profit. Okay, that's to give you a nice cushion in case your rehab goes over, or you need to negotiate a little bit harder and maybe go from 70%, you know, sometimes you can squeeze that up even to 80%, you know, if you need to, if you're in a competitive market. But as a rough estimate, 70% is a good place to start. And then you minus any of your repair costs. So to find deals quickly, you need to know your ARV and your repair costs. Those are two things that you need to know in order to evaluate properties very quickly. So how do we find that out? How do you know by looking at a deal if it's going to be something that you could BRRRR or not? And I use BRRRR as a verb, I guess here, but yeah, that's what people do. It's like, if you ever go to investment clubs or talk about it, I don't know, can I BRRRR that? I know it sounds completely silly, but people talk like that because it has a meaning. Can I use the BRRRR method to particularly buy that particular property? So let's kind of go over ARV. And I know, Edward, okay, man, stop with all this crap. Get to it, man. How do I get free rental properties? That's it. You know, cut through all this crap. I don't want to hear about Mayo. All righty. Let's find out how to find a BRRRR deal. Okay, so here's some of the things that you need to sit back and look at. First of all, you need to pick the area you're invested in. You want to invest in. Now, you can't have, I wouldn't say can't. I hate using that word, and I'm sorry that I used it on the presentation. It's very challenging to have a wide area where properties vary, neighborhoods vary, and then know the ARV and repair costs of every particular property in every area. It's kind of challenging. So I would urge you to pick an area, well, and I'm kind of jumping ahead of myself. We'll go over how to invest in, but pick an area that you want to invest in, and you know that area's ARV and repair numbers very well. So therefore, if a deal ever comes up in that area, boom, you're on it right away. You know exactly how to evaluate it, and that's your sort of bread and butter area. So again, how to pick the areas, how to find the deals, know your renovation numbers, how do you get the property rented? Okay, because that involves landlording and or property management. We'll talk about that, and then how to find your finance partner. That'll help you refinance. So pick your areas, and again, your area. This right here is a little bit more local. This is assuming that you're doing local investments. You could do national investments if you guys want to. If you're in California and you want to invest in the Midwest, in Missouri, Indiana, Tennessee, just because the properties are going to be cheaper and the numbers work out better, great. Know your state, but in that particular state, you're going to have to know your zip code or your school district. You're going to have to go down to that level in order to understand those particular values in that area. What type of asset do you want to buy? Single family, multifamily? Do you want to buy duplexes, fourplexes, 10-unit buildings, 20-unit buildings? It's completely up to you. So you have to know your asset class that you want to go after. How many bedrooms, how many bathrooms, square footage, what rent amount do you want to look for? All of these things determine, if you can get laser focused on all of these things, then you have the area, what you're looking for, how many bedrooms, bathrooms, at least a minimum square footage. That right there now makes you laser focused. Now you don't have to look at every property that comes across your list. I'm only interested in properties that meet this criteria. Now, let me just take a quick minute and just sit back and say this. Because you can buy a property using the BRRRR method doesn't always mean you should, okay? And I'm gonna say that again. Just because you can do a BRRRR deal doesn't mean that you should, okay? Because keep in mind, you're gonna be tied to that property moving forward. If that property is small, if it's a 1-bedroom, 1-bath, for instance, and you could buy it and get it for free, if 1-bedroom, 1-bath is not in your area of expertise, that's, the rent amount is not where you want it to be, then don't do it. Don't get involved unless it meets your minimum rental amount or, what all these criteria that I'm talking about here. So find what those criteria are and don't differ from them, because I've seen people try to do BRRRR methods on properties that they shouldn't have. And pretty much those properties are going to be in areas that you don't really want to have or manage, if that makes sense. So just please be careful about that. A lot of people just think because you can, you should. And I don't necessarily agree with that. If we agree to disagree, great. But I just, that's what I recommend to people. Buy in the areas that you want, that are going to appreciate. Now, how do you find the deals? So because you guys are a real estate investment club, as you listen to more and more speakers every single month, if you're wholesale, if you're rehab, you know about marketing, direct mail marketing, how to build a list, how to go out and find a list of people, of houses or properties that meet a certain criteria, and then you can send direct mail to them, letters, postcards, bulk email, all that kind of good stuff that you can do. You can do that. But again, if you don't know about that, then that may not be the best way for you because it requires money. You do find better deals that way. But one of the other things I would suggest is find your local wholesalers. Find those people out there that are doing this stuff already and get connected to all of those people. So I'm sure there's people in your group that do this. Find the area that you're looking for, or if you're investing in another state, find people in that area. Go online, look for REIA clubs in that area. Try to join those REIA clubs online. Again, it's a virtual environment. Join them online. Attend virtual Zoom meetings. Attend meetup groups at meetup.com. It's another great site to go look for investment groups. So these are great areas to go look and post stuff online. Hey guys, I'm looking for 3-bedroom, 2-bath property in this zip code. I need at least 1,200 square feet and rent for at least $1,500 a month or more. If you get that kind of a deal, send it to my email address. Boom. Have those people go out and work for you. Now, if the deal works for you, great. If it doesn't, you're not obligated by anybody to respond to them. They're just going to be sending you deals. And if it works for you, great. But this is a way that you can get people to go out and find and bring deals to you if you don't want to go out and do your own marketing. So that's just real quick. One of the other things I do give people is try Facebook groups. Facebook groups have been huge here for people if you want to buy properties or find buyers or find wholesalers. Because if you go, let's just say you're picking St. Louis, and I'll just throw my city out there, find local investment Facebook groups for St. Louis, join those groups, and then start searching the posts in there for investments or posts out there. Hey, I'm looking for properties in this area. Again, with these qualifications, if anybody has anything, please send me an email here, or please send me a private message. Those are things that you can absolutely do completely free of charge and have everybody in that area looking for you to send you deals. That right there is a great way to at least get started to try to find the deals that you're looking for. So next, how do you know your numbers? So here, once you find the deal, you need to be able to determine the repair costs. So right now, for most deals, you're going to have pictures and so forth, and this does require some skill. If you're looking at pictures, you're going to need to know what some of the costs are in the area. Again, this goes back to hopefully partnering with other wholesalers in the area, asking them questions, because contractor and repair costs, material costs in St. Louis is going to be different than in California, or in Missouri going to be different than California. Sure. They're going to be different. So right now, the cost for California, the cost for Missouri is not going to be the same if I moved over to California. Right now, in our area, if you're doing, for instance, Lori had mentioned, if you're doing new construction and you know what you're doing, you could probably do it for $200. If you mess it up, you're going to be doing it for $350. In our area, we're more like $120 for new construction. So again, we're already different from just a new construction build. So anyway, you need to know your numbers, and you need to know what things cost. And that's going to take a skill that you're just going to need to develop. Now, people in your local real estate investment group can help you. There are other calculators, rehab estimators out there that can help you. But right now, you will need to know your repair cost numbers. Unfortunately, that's not a quick, easy thing that you can do. You will have to take practice and just get better at it. So now you've got the property renovated, rehabbed, and now you need to get it rented, because getting a loan on a property is going to be much, much better if that property is rented. So now, if you're going to have a rental property, big question I always ask people is, do you want to self-manage or do you want to hire a property manager? Okay, that's going to be completely up to you. It's a personal preference. Some people like to manage their own properties, get control and so forth. Other people are just, hey, I'm an investor. This thing is just an investment to me. I'm going to hire a property manager and let them do it. And I'm going to factor the property manager's costs into my rental property, into my cash flow numbers, so that now if I know I need an additional, let's just say 10%, that's a pretty typical nationwide average for property managers' fees on a monthly basis. Now, the more you have, it can go cheaper, but let's just use 10. If you have $1,000 a month rent, they're going to charge you $100 a month for managing it. Okay, so if you have that, you need to factor that $100 into your numbers so that your cash flow comes out correct. Because if you want to make X amount of cash flow each month, then you need to accommodate for a property manager, vacancy, maintenance, and so forth. And again, that's a whole other topic about that, but those are just things that you need to include, where if you self-manage, then even if you do have that same buffer, you're making more money. Okay, but again, you're working in your particular business instead of it being a standalone I'm just the investor and I just hire somebody else to do that. And I'm out looking for more BRRRR deals. That's what your job is. So again, you need to make that decision. Again, that's more of a personal preference for you. Obviously, if your property is remote, then you're probably going to have to hire a property manager, because if you're in California and you have a rental property in Missouri, you probably don't want to fly or drive here every time you need to deal with something. Probably won't be cost effective. So last but not least is a refinance partner. So when you get the thing done, I would say try your local bank. Of course, it's always the best thing. Try a local bank, local credit union. Those are the people that want to lend out in the local community, probably going to end up giving you the best interest rates. Again, I told you I get stuff every single month, every day. I lied, at least several times a week. I lied on that one. I didn't think I got one today in my email, but I get them at least, a couple times a week from different funds or whatever that go into my junk mail that sit back and say, hey, funding for this, funding for that. It's all over LinkedIn on my LinkedIn account. It's just, I get it every single day from people. Hey, I got funding. You're in real estate, you're a property manager, hey, I've got funding for you, come use my money. So they're out there. So it's going to take finding somebody that actually will do it. And then once they do it, it's a matter of just doing it over and over again. So I know we had some great feedback earlier about, how many properties can you buy? That's kind of getting a little bit specific here, but I think right now, that's about it, guys. I mean, at the end, I'm just trying to give you enough information, kind of set you on your way. These are the things that you need to look for. So at this particular point, this is where we applause, yay, and ask questions. So, so great. So right now, let's open it up to just people experiences. I love people if you have experience with this. I'll start out just with my own. I actually used, back when I was started doing BRRRR deals, 07, 08, in that area, I actually used line of credit at that particular point. I didn't have private lenders. I didn't have all these financing options. So I used the easiest thing, since I didn't have that much cash. I just had a lot of equity in our home. So I used a line of credit, and I used that line of credit to purchase rental property, and I purchased it and I did the fix up with it. And then once I fix it up, the purchase and fix up costs were at the time less than 80% of the total after repair value. And at the time, banks were doing 80% cash out refis all day long. I could do it, no brainer. I get it, a property, so let's say $100,000 property. If I could purchase it and get it fixed up for $80,000 or less, then I was golden. I would just simply get it rented, simply refinanced, got a mortgage note on it. At that particular point, I got all of my money back. I paid off the line of credit, which again, at the time was only maybe 4%, something like that I had to float for 3 or 4 months. So I had to pay 4% on the line of credit interest rate for 3 or 4 months. And then I got all the money back when I refinanced. And then I got a property worth $100,000 that had $20,000 of equity, and it cash flowed. So how can you not beat that? Until what happened in 08. So in 08, a lot of my properties lost equity, which sucked. But even though it lost equity, I still did the numbers correctly, so it still cash flowed. So that's just my story, and I'm willing to entertain questions or help anybody out if anybody has anything. SJREI team,
all right,
questions pop up?
so everyone, you guys can put your questions in the chat, or you can raise your hand on Zoom. There's an option called raise hand, and it'll come up for us to unmute, and you can ask him directly. So now is your chance to pick this brain here.
Let me ask a first question then. And thank you for the presentation. And my question is, once you finish the BRRRR for the first 10 properties, the lending getting very hard. And sometimes lender look at your portfolio and say, well, you have too many small, little small loans. You probably make better sense to consolidate. It's getting harder when you hit 10 property or above. So what is your suggestion or recommendation?
Right now, my recommendation is, I saw it over there as far as doing partnering with people to get around that. Again, partner with people who do have credit, who don't have loans. That's another technique I saw that kind of made me laugh on the chat a little bit earlier. But one other option that people don't realize is go to your local bank or credit union and get a portfolio loan for all the 10 properties that you have. So right now you can actually, when I say a portfolio loan, it's more or less a locally held commercial loan that they will give you, and they will just refinance basically all of your 10 properties. Again, 10 single families or a 10-unit building, to the bank, it really doesn't make any difference. So they'll sit back and refinance and wrap all those 10 properties under a commercial loan. And now it wipes out all of your 10 residential loans that you've got, and you've got one commercial loan that doesn't even show up on your credit when people look for it. And then you go do it again until you hit your limit of 10, and then wrap all 10 of those up in a commercial note as well. Just a way of handling that. Excuse me.
So Ed, what is the seasoning that you're seeing in the marketplace right now?
Not sure what you mean, Lori. Sorry about that.
So like you purchase it and you do the renovation, how long do you have to hold it before you can go back and get either a rate and term refi or a cash out refi?
I mean, it's months. I mean, banks, if you're using your own private money or whatever, banks are not, at least in my area, they're not requiring seasoning. You could do them every 3 months if you want. Okay. If you get it done in 2 months, again, the bank just looks at, again, how many loans you have, your debt to loan ratio, all that kind of stuff gets calculated. But as long as you're a pretty solid person and the bank has confidence in your ability to turn a property and renovate it and make money, they'll turn around. So the seasoning really isn't even there. I've seen that clients of ours that do it inside of 2 months, if they can get the renovation and get it rented quickly enough.
That's amazing, because some of the experience I've had is it takes up to 6 months. So I was just interested in what you're seeing in your marketplace. So
yeah, some of the banks, again, the local banks, you just have to find the right refinance partner. Just because you hit one, and if you go to some of the bigger national branches, you're going to be told no a lot. No, we don't do that. No, corporate policy says we don't do that. No, that's too risky. We don't do that. So find the local providers, find the local banks. These are people that have money that want to invest in the local community, but they have to be able to know you. You have to have a relationship with them, and they have to understand your background. They have to understand this is what you do and have confidence in your ability to take a property, renovate it, get it rent, and then manage it. Or if you're not going to manage it, have a professional property manager handle it. That is a big concern to the bank, because that's their asset. If you have no experience as a property manager, then they may want you to get a property manager on board, somebody a little bit more experienced than you, if you don't know how to manage it.
So we have a question here from Marie, and it says, do you have any suggestions outside of California? For example, Indianapolis, Phoenix, etc.
As far as what, investment opportunities?
Yes. Yeah.
Oh, I mean, anywhere the numbers make sense. So and take Indiana, if you have family there, that may be a good stopping point. You might go visit family and look at your rental properties at the same time, or have family be able to go take a look at it. The area that you're talking about is just a matter of what purchase price of property versus the rental amount makes sense. In some markets, it makes a lot of sense. In other markets, maybe not so much. But you also have to factor in, what are the markets that are hot? What are the appreciating markets? This is where, if you're sitting back and you're looking at how to analyze and look over nationwide properties, where do you find a tool for that? I can't really give you a tool. I'm sorry, I don't have one. But how do you look at statistics? Even I'm sure Zillow probably has them. What's appreciated? What's the growth market over so many years? And factor that in as well, because you might want to be a little bit more risky on appreciating markets, even though those appreciating markets may not cash flow very well. So it depends upon your need. If you're younger, for instance, younger people may be more risky. So they may say, hey, I'm going to go after the appreciation, because even if this thing doesn't go right, I still have time to recover in my age. Versus if you're older, and this isn't about age, guys, I'm just trying to say 50, 60 years old, people in that time frame may look for growth, may look for security. They may not be about the risk, because if they lose that much, they don't have 40 years to get it back before they start needing the money. So cash flow may be better for them, and mortgage pay down may be better for them, and having a free and clear property than getting $100,000 a year worth of appreciation.
Yep. So where in Missouri are you, and what's the median price?
St. Louis, and we're right around 160, 150, 160 for median price. And
then where do you get the repair money from?
again, from any particular place you can. A lot of our people that do stuff here locally just use hard money. They use hard money loan for initial and then use private money for the refinance. And then the person doing the private lender understands that they're taking a second position against the property, but they have confidence that the investor is still going to keep that amount of money under, at this particular point, a lot of people stay under 70% of the ARV just to kind of keep it safe. They don't really push it up higher, because if they do, they're being a little bit more risky with the private lender's money.
Awesome. Jane, I saw your hand up. Did you want to ask a question?
Well, I'll make a comment. Edward, you are the first person I have ever heard not go cash flow, cash flow, cash flow. Everybody else in my 40 plus years of investing in real estate says cash flow. You have said, and I agree with you 100%, that maybe cash flow is not the most important thing. Maybe it's depreciation and appreciation.
Mm-hmm.
I remember in the 80s when I was selling real estate, I had a negative cash flow of $4,000 a month.
Ouch.
Pardon?
I said, ouch.
I was making good money selling real estate. I was very successful. I had no problem paying $4,000 a month.
Uh-huh.
But some of those properties I still have. Now, at that time, properties were going up $1,000 a month. So I was basically more than breaking even at the end of the year.
Good. Suspense. Did we lose her?
Jane, you kind of froze, or am I frozen?
No, I see you. Jane, we lost you. You froze up. So we heard the $1,000 a month and then you froze. So you left us suspended at the story.
Okay, well, can you hear me now?
Yes, we can.
Okay. So, so properties at that time were going up $1,000 a month.
Mm-hmm.
But today in our area here, they're going up $1,000 a day. So who was the smart one? I think I was.
No, see, that's the thing that I try to get basic information out, but you can use the information like puzzle pieces and move them around and put them together in different ways. So if let's just say you want to invest in Colorado. Colorado is an expensive market. Very, real estate goes very fast out there. But let's just say that you do want to buy a property in Colorado because it has great appreciation and you like to maybe go there, whatever, and visit. But you can also, that's your appreciation property. Okay, so you might not make as much cash flow, but now you've got 10 rentals over in Indiana that are cash flowing, but the appreciation may not be as much as the one in Colorado, but you're hoping that those 10 properties in Indiana, once you get the money from those tenants, that they're going to pay and offset the cost for the Colorado home, so that in 15, 20 years, depending on what your loan is, you own that Colorado home, and that's where you're going to go live whenever you're done. And that's a part of your investment strategy. That's just an example of how you can use the things that I just talked about in different ways to achieve what you want to have in life, to achieve your financial freedom.
I appreciate so much what you're saying, because everybody thought I was really stupid for paying $4,000 a month negative cash flow. I didn't think
Jane,
I was.
I don't think you're stupid saying that I'm right. I think you're right on the money. I think you're absolutely dead on.
There you go.
Great for you.
All right. Thank you, Jane. Ed, we have another question. Did you ever have any bad tenants? If so, how did you deal with them?
Sorry, guys, I don't have 3 more hours tonight to discuss that. So let me kind of give you the short answer on that one. Yes, I've had sucky tenants. I have had tenants that have taken advantage of me because I didn't know any better. And that's just because as a landlord, many, many moons ago, bought my first property in 2005, sorry. If you people remember 2005 and 6, again, if you look at that chart that Lori had, is that a growth market or was that a declining market in 2005 and 6? I'll just tell you, it was a growth market. You know, properties were going like crazy. Everybody was doing stuff. And then 2007 and 8 came, and that's where the downside came. But anyway, I bought property during that time and then I didn't do it the right way. So that's why I go out and help teach people about how to invest in rental properties, what to look for, because I look back and I really wish I can go back 15 years and help that guy I was 15 years ago buy a better property and not get taken advantage of and lose tens of thousands of dollars because I just didn't know what I was doing, didn't know what my rights were, to what authority I had over people and so forth. So I didn't use that. And as a result, people kind of walked on me, cost me a lot of money when tenants moved out. And eventually, I mean, I don't personally go, I do evict people. As a matter of fact, if you guys saw some of my Facebook posts today, I think I actually got a call from the sheriff's office. They're opening up evictions now. So it's amazing. All the tenants that we have that are evicted, it's amazing. They all called me and contacted me. How can I make a payment plan? How can I give you money? Can you send me that link again where I can make a payment again? Because now they're getting those notices on the door that says, you know, date to vacate from the sheriff's office, and it's scaring the crap out of them. So anyway, I don't necessarily like to evict people, but I have to, because unfortunately you have to push people to that point sometimes before they'll respond. And that's just a fact. Thanks so much, guys. Appreciate the questions. Anybody else? Buying methods, BRRRR method. I'll just, unless there's another question, I'll just kind of keep yapping about a few things. A lot of times people have the problem about buying. So buying properties, finding money, finding cash flow. Here's the worst case scenario. If you have cash, great. You know, this makes it easy. If you're sitting there with $1 million in the bank, you can go back and find all these deals and you don't need anybody else. Just use your own money and move forward. And as long as you can get them refinanced, you're good to go. And you get all your money back. So that's one way. But one thing I did not mention actually is credit cards, believe it or not. Now, I'm not a big component of going into debt. I pay my credit cards off every month that I use, except the ones that I purposely use as lines of credit. They're they're lines of credit that I can borrow and write checks on to take $50,000 out of this credit card, $50,000 out of this one, and I've got plenty of them. So, I mean, if I need a couple $100,000, it's just a matter of, you know, getting some checks, cashing them. Of course, there are fees and stuff like that that I have to pay, but a lot of my cards are 0% interest for 12 months for borrowing money. And it's like, as long as I get that money paid back inside of 12 months, all of my payments I make are completely principal. I don't even pay interest on the money I'm borrowing. I just pay like a 3% fee, which I just consider a cost of doing business. But that's another thing that people may do. For Lori, you had mentioned something about fix-up money. Well, if you use private lender or a line of credit or again, a hard money lender, take all these things I'm telling you as pieces and move them around and see how well you can make them work. But credit card could actually be a gap funding that you need for the rehab. If you need $20,000, can you get $20,000 off a credit card? Can you do cash advance off a credit card? And okay, so say that you borrow $20,000 and they charge you $1,000 for taking it out. So now you just have to factor $21,000 into your total cost and just make sure that you know the numbers make sense whenever you do it. But take all these different things and look at your life and look at all these tools and pieces that you have around you and start putting them together. Well, if I took the hard money lender and put them here and, you know, I qualify for this and I can get, you know, Aunt Betty, she's got money in her savings and I can borrow her, she'll give it to me and I'll just give her 5% interest rate. She'll be happy about that. Then I can do that. And yeah, I can make this deal happen. So you start getting ideas. I mentioned the word can't earlier, and I'm really trying to prevent myself from saying that. And again, I apologize. I'm not the person that likes to say I can't do things. It's always, how can I do things? And I learned that back from Rich Dad Poor Dad. It was one of the books that kind of changed my life and shot me where I am today, is just kind of changing your financial thinking. So always think, how can I do this? Because when you think, how can you do it? Then that gets your mind thinking. If you say you can't, your mind just shuts down. Doesn't even bother trying to figure out a way.
Hey, Ed,
Yeah.
how do you determine when to sell one of your rental properties?
When people are greedy and they'll pay more money for it. So why not get out and look for another deal? So, I mean, right now over the last year, I've sold lots of rental properties. Why? Because it was a time to sell. People were being greedy. I love Warren Buffett's, buy when other people are scared and sell when other people are greedy. So if people want to pay more money for it, great. I'll take their money, take the money from that property, put it in the bank, and then I know how to go market, look for other properties that makes sense for those numbers and buy another property with it. Or buy 2 properties from that one property I just sold.
I get it. Ed, I always see this, and I guess this is my question, right? I always see this kind of theme, right?
Mhm.
And maybe it's just my YouTube stream, I don't know. How to start investing in this, the BRRRR method, with zero money. Is that another presentation, or do you got like a quick?
No, I mean, that's what that presentation basically is trying to get at is no different than what I already told you. When it
Right.
says zero money, it doesn't necessarily mean that you may not have zero money out of your own pocket. I mean, if you had a private lender, for instance, could you borrow all the money from a private lender against the deal, the purchase, and the fix-up? If you had, again, let's just say Aunt Betty had $1 million in the bank. Okay, would Aunt Betty wouldn't mind loaning you $150,000 and $30,000 in rehab to buy a $250,000 or $300,000 property? If Aunt Betty trusted you, then yes. Well, if she gave you all the money to do this and you put it into play and you got it, follow the method, you refinance and got all of her money back and gave her money back plus an interest rate, how much money of yours did you actually use on that deal? You didn't use any. You used other people's money, which is hard money lenders, banks' money, maybe a line of credit against your property, things like that, as long as the numbers make sense. But the biggest thing about this is make sure you don't buy a BRRRR deal just because you can. Can't stress that enough. And then just make sure that you get in, you get it done, and you get it out quickly. So what that means is when I talked about renovation, we didn't really go into contractor management, having subcontractors, electricians, handyman contractors, HVAC people, but you're going to need to have those people. That's a part of your renovation team. If you're going to go in and do it, you're going to need to know who these people are in your local area and have them lined up. Not only that, you're going to need to get bids from these people to make sure that you can present it, because if you're doing hard money, the hard money people are going to want to know the bids on that particular property, because they're going to loan you money and you're most likely going to have to do construction draws if you're borrowing money from them for the rehab. So I hope that makes sense. So again, I glanced over stuff. There's more stuff deep down, but again, that'd be maybe a 2 or 3 day class sitting here going through all of that. If you really wanted to dive into all of it, I was just trying to get a high level to kind of show people some of the big high level puzzle pieces to kind of move them around and start making sense of them.
I get it. So Ed, do you look for properties that only need simple repairs, or do you also include in your search properties that need like major repairs? Like, do you have a rule? Like, do you have a percentage of what you estimate the repairs to be?
Not really. I mean, the problem with major repairs, if you're dealing specifically like with foundation repairs, things like that, those take time, because most of the time you're going to need to get structural people out there to see what needs to be done to get it fixed, and it's pricey. I would do it only if the property is in a really great area, like a great appreciation market, and nobody else wanted to deal with it. Because again, any problem that you have on a property can be fixed by just writing a check. And I just want to make sure that you understand that. You can just write a check. Again, if the numbers make sense, write a check and that problem is solved. That's it. It's just a matter of how many checks are you willing to write and how long is that going to take you to turn it around. Keep in mind that getting in and out of a real estate deal, I'm kind of going away from BRRRR for a second and just kind of focusing like on if you're a rehabber. If you're rehabbing a property, you don't necessarily want to rehab a property that takes 9, 12, or 18 months, because what can happen during that time frame? The market can shift. Stuff can happen during 9 or 12 months. That's way too long an exposure to try to be out there rehabbing a property. So this is where, even people that are doing new construction, they're popping these things up in 3 to 4 months. Boom, 3 to 4 months and that property is up and gone, sometimes sooner, depending on the process. But if you can get in and out of a property quickly before the market has a chance to shift, that's where it's key. And then that way, once the market shifts, then you don't bother getting into it, because it's already shifted and you already have a rental property that was refinanced at a low interest rate, even after the market shift, just like Lori was saying, and now you're golden because you have a great property and you just wait, be patient and wait for that deal to come along. Look for it. But as long as you know what you're looking for, I love it. I'm a great fan of Tony Robbins. Tony Robbins introduces something called the reticular activating system. If you ever heard about that, RAS. So once you know what RAS is, you kind of understand, what you're looking for. And one of his, if you listen to Tony Robbins as much as I do, it's just, you hear about this all the time. He says, he has these little cool things. He says, okay, look around the room, look for everything that's brown. Look, give me everything that's brown, 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 brown. Tell me everything that's brown. Okay, great. Now close your eyes. Tell me everything that you saw that was red. You're like, what? I wasn't looking for red. I was looking for brown. So that's the whole point. If you're looking for a particular color, you see it. Same kind of type of thing. If you buy a new car, you start seeing that car everywhere. You never noticed it before, but now you start seeing that car everywhere because you're looking for it. So if you're looking for an opportunity, if you're looking for a deal and your eyes are open, you can see it. That's why I'm trying to introduce, these are what you're looking for. If you're looking at this zip code, this school district, this number of bedrooms, and the purchase, if they're asking this amount for it, and again, they say it takes this much money, it might be worth looking at. So once you see a deal like that, you don't even have to think, boom, it becomes instant. I want that deal, you're calling them, that's my perfect BRRRR deal. That's exactly what I'm looking for. So you don't have to even think about it. You automatically know. So sorry about that. I went off on a little bit of a tangent, but
hey Ed, would you ever add a pool to your rental property? Like say that you bought it was in good shape. Would you add like a pool as an attraction, something like that?
I would not. Again, I'm not trying to speak for anybody else because pools are a depreciating asset. They don't go up. They always require maintenance. They always break and they're very expensive. So I've actually had people and students that have filled in a pool. A house that had a pool, they'll just fill it in with dirt, level over it so that they don't even want to destroy it and get rid of it. They'll just fill it in and just, hey, it doesn't exist anymore because they don't want the liability of somebody falling, drowning. I hate to think about it, but just kids, protecting, from kids and stuff like that, from drowning and stuff like that, but just too much of a liability. So I personally would never have a pool on a rental property. I just think it's not necessary to get the same level of rent.
Got it. Hey, Jane, you had your hand raised. You have a question?
I do. Well, I have a comment. You were talking about ways to come up with money. Mm-hmm. This past week, I represented a buyer who won over 35. There were 35 offers on the property. Mm-hmm. They took his offer. Why? Because he came in with all cash and could close in 10 days. Mm-hmm. So they took his offer over 34 other offers.
Yep.
Now, where did he get the money? He had some stock, and so he borrowed against his stock account at the wild roaring rate of 2.36%. He does not have to pay that money back at any particular time. It's adjustable, so if the market goes up, his goes up. But what he was planning to do, and we'll still do it, anyway, we close tomorrow. Mm-hmm. He's already got his cash in the title company, and then he will go to a regular lender and get a 30-year mortgage for, I guess, about 3.25%. And then he'll pay back his 2.36% loan to his stocks. So he just borrowed against his stocks. He had instant money. All he did was write a check and he had cash.
Well, again, Jane, that's another technique that you can throw out to the group. I mean, I started getting interested in a term, infinite banking. If you've ever heard of that, that's another term, whole life policy, where you get to borrow against it and be the bank and stuff like that. I mean, those are a lot of different ways that you can definitely get things set up. But again, unfortunately, if you don't have any stocks,
well,
you can't borrow if it's what you don't have. So, but no, that's cool. That's cool that he could borrow against it and come up with a lot of money and make his offer better than others, for sure.
Anyone else have questions for Ed? Let me go through the list here.
So I guess while we're waiting or so, one of the things I would urge people, if you are a wholesaler or even a rehabber that goes out and finds your deals, please don't do every deal and sell it. You know, cherry pick them. You know, if you're a wholesaler, that deal that that you're going to sell and make 50 grand on, you know, it's like, oh, this is going to be the big one, 50K. I can buy me another car, a new car, or whatever. And I can do it. Yes, but that would make a fantastic rental if you just kept it instead of making the $50,000. It's kind of like what's the word I'm trying to think of? Not instant gratification, the opposite of that, but delayed gratification, sorry. But if you have delayed gratification and just said, hey, I don't need to make this big check right now. I'm going to put this into my pipeline. This is a great area. I got a great price on this thing, and I'm just going to make it, turn it around and make it a BRRRR deal, and I'm going to cash flow this bad boy and get it paid off early, and this is going to be a great retirement property for me. So I would just urge you, take one property out of 20 that you wholesale and just keep one. You know, keep one of those prime ones that come up that you're really going to make a lot of money on. I just urge you to start building 1 a year, 2 a year, to particularly do this, especially if you have the funding sources available. I've told you all the pieces that you need. Now it's just a matter of finding all the components that you need, putting them in place, and then implementing.
Hey, Ed, how do you title your rental property? Under an LLC?
Well, now we're going to be diving into a different topic here, but no, I actually use land trusts for all of my rental properties to sort of hide them. Sometimes I'll use the same trust on multiple properties, but again, you know, just land trusts are how I hold my rental properties. And then behind there ultimately is an LLC that owns it. But yes, it's a matter of kind of a hierarchy. And again, that's a sort of an entity structuring class, a little bit more advanced for people. And I hate to blow people's mind on top of everything else I talked about here, but I saw Lori nod and she knew where I was going with that.
Have you done any multifamily?
No, I mean, right now I've stuck with single family. That's going to be my next thing. A lot of my my friends just keep saying, you know, yes, you know, you keep doing that. What you need to do is go out and buy a 60, 80, 100 unit complex and, you know, spend 2 years turning it around and make $1 million. And I'm like, that's a lot of work. Yeah, that's a lot of time that you're putting into that bad boy. But anyway, that's my next venture, is to start doing that because I've got all the pieces, just a matter of putting it in place.
Okay.
I just want you to know that I'm here, I'm listening. I have construction going on in the background. So when they're running the saws, I thought maybe it'd be better if I muted myself. So never go, oh, there you go.
The chat has just devolved into a which military branch is better chat. So, okay.
All right, I think that's it for tonight. I want to thank everybody for your wonderful attendance, and most importantly, thank you to Ed for giving us this great information. I hope you take it and you put it into action, and you come back a year from now giving us all a report card on how well you did with the BRRRR method, and you all get A's. So Ed, any closing remarks?
Nope, not at all. Just put the pieces together, go out and take action, make it happen. And then, you know, find additional resources. There's a lot of great BRRRR material out there for diving into the components that I told you about. I just tried to give you the high level view. It's kind of up to you to go deeper into finding all the little components about how to build a rehab team, how to find the refinance partner, how to set up all your financing and stuff like that. It does take a little bit of time. You're building a machine, you're building a system for how you're going to do this. But think of it like an assembly line, you know, a manufacturing production plant. Once you get it going, now you can just crank these suckers out. You know, it becomes a production line. Boom, it goes to this phase, this phase, this phase, ends out with a house in your portfolio. Start again, over here, goes on the assembly line, boom, it ends with another property in your portfolio. So just think of it that way, and you're building all those pieces of the production line. That's what you're doing. And once you got that system in place, you're cranking them out. So go do it. Thank you guys. Thank you, Lori, for having me on the meeting.
Thank you.
It's great
It was
to
great.
talk to all you guys.
Thank you for an excellent presentation. Have a great week and we'll see you next month, everyone. Bye-bye.
Bye-bye.
Thanks, everyone.